You might think you need to throw thousands in extra repayments to pay off your home loan faster. But here's the thing, just by setting up your accounts a little differently and being smart when your money goes in and out, you could shave years off your mortgage. You don't need a pay rise, and you definitely don't need to give up your lifestyle. Hey, I'm Jason. I've helped hundreds of everyday Australians pay off their home loans faster. I worked in commercial property research with CBRE and Colliers. I was previously a buyer's agent. I worked as a head of credit, as a lender, and supported award-winning brokerages in scaling up. So I get how the banks think, and more importantly, I know how to make this work for people like you. Let's break down the 3 strategies I walk through with almost every client who wants to pay off their mortgage faster. I'll start with the offset strategy first. The first thing I tell people is you don't need a massive surplus to get ahead. Not if you're using your offset account properly. So what's an offset account? It's basically a separate bank account that's linked to your home loan. Here's how it works. You make your normal minimum repayments on the loan as usual. Then you transfer any extra cash into the offset account. While it's sitting there, it's helping reduce how much interest you're being charged. The more money you keep in there, the less interest you pay on your loan. Any money you put into that account is treated as if it's already paid off part of your home loan for the purpose of calculating interest. The beauty of that is that you still have full access to that money since it's an everyday transaction account. So, if something unexpected comes up, or you need it for a big expense, you can just pull it out. Let me give you an example of how it works to reduce your interest. Let's say you've got a $500,000 home loan and $50,000 in your offset. Instead of being charged interest on the full $500,000, the bank calculates your interest on just the $450,000, the difference. One thing to keep in mind with this strategy is that the bank calculates your interest daily. Offsetting $10,000 for one day saves you $1.64 in interest. Similarly, offsetting $1,000 for 10 days also saves you $1.64. So if you really want to benefit from your offset account, it's not just about how much is in there, but also for how long it's in there. What I recommend to clients is to shift the bill due dates to just before payday. That means your full salary can sit in your offset accounts for 2 to 3 weeks before any bills are paid. And during that time, it's helping you pay less interest. I'll use an example again to explain. Let's say you have a $500,000 home loan at 6% interest, and your repayments are around $3,000 a month over 30 years. Let's say your monthly salary after tax is $4,000, and your expenses, including your mortgage repayments and other outgoings, add up to $3,990. That leaves you with a surplus of roughly $10, and to be exact, it's about $2.25 a month. Most people think they need to be making extra repayments every week to get ahead. But what I'm showing here is that even with a $2.25 monthly surplus, if you've got that initial $4,000 sitting in your offset, you could shave almost 7 months off your mortgage just from that starting balance and correct account setup. Now, if you don't have any funds in offset to begin with, and you're working with just a $2.25 surplus, you might only shave 1 or 2 months off your loan. But if you've set aside 1 month's worth of living expenses, say $4,000, in your offset to begin with, then that tiny surplus works harder because your interest is being calculated daily. Now, here's where it compounds. Let's say your monthly net income after tax increases by just $166, from $4,000 to $4,166, and you keep your expenses the same. That extra buffer grows your offset account each month, and over time, that momentum builds. Stick with that discipline, and by the end of the loan term, tipping your offset balance back into the loan could reduce your loan term from 30 years to 25.5 years. That's nearly 4.5 years saved just from getting set up properly and being consistent. So that's strategy number 1. One more thing. Before we move on to the next strategy, make sure your offset is properly linked to your loan. We still see clients whose accounts aren't linked correctly, and that wipes out the benefit entirely. So just double check that. Second strategy you might want to consider is debt recycling. This one's a little bit more advanced, so let me explain. Debt recycling is a way of making your home loan work harder for you. Instead of just paying it down over time and letting your equity sit there, you use that equity to invest. At the same time, you're converting your home loan from something that's not tax deductible into something that is. Here's the idea in really simple terms. Your home loan interest is usually not tax deductible. But if you borrow money to invest in income-generating assets like shares or property, that's good debt because the interest usually is tax deductible and the asset is growing in value. So with debt recycling, you're recycling non-deductible debt into tax-deductible debt over time. You're still paying your home loan off, but at the same time, you're building wealth and potentially reducing your tax bill. Now, you'll need to clarify that with your accountant exactly what deductions you'll be entitled to claim. But let's break that down step by step. What's equity? Equity is the portion of the home that you own outright. It's the difference between what your property is worth and what you still owe on the loan. So if your home is worth $800,000 and your loan balance is $500,000, that means you have $300,000 in equity. Now, most people let that equity just sit there, but with the right structure and advice, you can actually put that to work. Let me walk you through the two most common ways to do this. The first one is refinancing. You refinance to release equity. Refinancing means replacing your current home loan with a new one, either with your current lender or a different one. People usually do this to get a better interest rate, lower repayments, or change the structure of the loan. In this case, we're looking at refinancing to unlock equity. Then you set up a second loan. That's your investment loan. Some people may use that loan to invest in income-generating assets like an investment property or ETFs. Once those assets start generating income, you can direct the income back into your home loan. If that strategy works for you, you can repeat. Of course, I must point out, this is not investment advice, and you should always do your own research to understand the risks. I'd also strongly recommend that you get professional advice with regards to your investment strategy because it's personal to you, your circumstances, and your goals. So please keep that in mind, and let's move on to the second method, splitting your loan. With the second method, you're going to use your offset account that we spoke about earlier. Let's say you've got $50,000 in your offset account like we discussed earlier. That money is already saving you interest, but you could use that same $50,000 to start investing. This does not involve refinancing. Instead, you ask your lender to split your $500K loan into two parts. Loan 1 will be $450K, Loan 2 will be $50K. You then take that $50,000 that was sitting in your offset and use it to completely pay off Loan 2. Now that second loan has a balance of $0. You then redraw that $50,000, but instead of using it for a car or a holiday, you invest it. That could mean buying shares, ETFs, or managed funds, anything that has the potential to generate income. Because the money you've redrawn is now being used for income-producing purposes, the interest on loan number 2 may become tax deductible. If you're wondering whether it's counterintuitive to take out more debt to pay off existing debt, let me explain why this could be a strategy to reduce your home loan. Let's say you decided to go with the loan splitting strategy and invested 50 grand into shares. Those investments give you a 6% return. That's $3,000 a year or $250 in dividends every month. Instead of spending that money, you direct it straight into Loan 1, your regular home loan. So that's $3,000 a year in repayments, which is equivalent to making an extra month's repayment every year, which could reduce your loan term by 4 to 6 years depending on your interest rate. And because Loan 2 is now being used for the investment, the interest on it, let's say around $3,000 every year, is tax deductible. And let's say you're on a 37% marginal tax rate. That's $3,000 in deductible interest. That saves you around $1,000 a year or $92 a month in tax. You now have extra disposable income because you're paying less tax. That could also go into your home loan. This could mean that you're paying over $4,000 a year in extra repayments without earning any extra income. And if you're reinvesting each year, this accelerates. By year 5, you could have doubled your repayments from dividend income, shaving up to 8 years off your 30-year term. The last strategy is what I call invisible momentum. And it's simple. Review your income and expenses. This is really about creating what I call invisible momentum. You don't need to make massive cuts or go full spreadsheet wizard. You just need to be intentional. Start by taking a close look of where your money is going. Most people don't realize how much disappears into subscriptions they forgot about or weekly expenses that aren't adding any real value. When you track your outgoings, you often find breathing room you didn't know you had. What I recommend is to cancel anything that's not helping you live better. Increase your income if you can. Things like freelance work, getting a second job, or negotiating a raise can go a long way. Most importantly, automate your savings. Set up a direct transfer of 10, 20, or even 30% of your income straight into your offset or redraw before you even see it. It doesn't have to be a huge amount. Start with whatever you can do consistently. Here's a tip I give nearly every client. Put those savings somewhere you don't see every day. Separate bank, no card access. Out of sight, out of mind. You'll be amazed how quickly your spending adjusts without you even noticing. And that money just keeps chipping away at your loan. Even at $200 a month, that's $2,400 a year. And depending on your interest rate, that could knock thousands off your total repayments over time. $200 a month in extra repayments might seem small, but over 30 years, it adds up to over $70,000 saved and could bring your mortgage down by 5 to 6 years, just from better cash flow management. Another thing worth doing is matching your repayments with how you get paid. If you're paid fortnightly, switch your mortgage repayments to fortnightly as well. Switching to fortnightly repayments means you're effectively making 13 monthly repayments a year, not 12. That one extra repayment alone could reduce your loan term by 5 to 6 years, depending on your balance. It's a small tweak, but over time it adds up to big results. But, and it's a big but, a debt recycling strategy isn't for everyone. You gotta ask yourself, are you comfortable with market risk? Is your income stable? Can you stay disciplined when the market dips? Because if not, debt recycling can backfire. And that's why I only recommend when clients tick these boxes. You've got equity or cash available, you're long-term focused, you have the right investment strategy in place. So the bottom line here is that this strategy can work, but only if it's done properly, with a plan and with advice. Before I wrap up, I also want to mention that sometimes paying off your mortgage faster isn't always the right move. You have to think about this as well. For example, if you're starting a business or you're going on parental leave soon, you might not want to throw every spare dollar into the loan. Because once the money's in the loan, especially if it's not an offset, you might not be able to access again easily. You're locking away flexibility. So think about what you need your money to do before committing to aggressively paying down your loan. I'll wrap it up there. If you need more specific advice on your situation, I've left a link to book in a free strategy call below. Otherwise, make sure to subscribe and I'll see you in the next one.